In this session, I'm going to look at on an overall basis, just by looking at the income statement, what is the typical analysis that is performed, right? So, the major things which are expected to be covered is one, an understanding of the common size analysis. When we look at the income statement, one thing which we can quickly do is the common size analysis and a few exclusive income statement ratios. And typically, I look at them more towards profitability, because the net outcome that comes out of the income statement is the net income, which is the profitability. So some kind of a profitability assessments can be done just by looking at these ratios. So quickly, I mean, though in detail we would be doing slightly at a later point, but just to understand these two important mechanisms of analysis on an income statement, if I have to start off with common size, all we simply do is, this is typically called as a vertical common size, right? When I say this vertical common size, let's say I'm taking this example. So this is my income statement. This was something that is present in the annual reports of the company, and let's say we have summarized it this way. Now when I'm saying common size income statement, all we do is we try to establish each of these categories, each of these values as a proportion of the sales or revenues itself. So I'll take the sales, divided it by the sales. So that gives me 100%. Probably if I'm putting it in a percentage form, 100%, and probably when I'm dragging it across, I could see that yes, net income is 26.89%, or if I want, I could very well include the gross profit, right? I could include the gross profit here, simply saying the sales minus the cost of goods sold. So this is my gross profit, and the same here also gets computed as gross profit is 50.25%, right? And if I'm looking at the net income, probably I can here change the formula a little bit. Gross profit minus of all these, or operating income is where I had a problem. The gross profit minus the total expenses here, I should consider it as only these three. Yeah, so this is what is going as a part of my net income 26.89, operating income is 34.26, gross profit is 50.29. Now if I am establishing all these numbers of the income statement as a percentage of the sales or the revenue, I call it as the vertical common size. So for each year, that particular year's sales or revenue is what we fix it as 100, and all other numbers we divide by the sales or revenue for that particular year. That is called as a vertical common size income statement. But when I look at the horizontal, so probably if I have year 1, year 2, year 3, I have sales, cost of goods sold, gross profit, etc. So A, B, C, D, E, F, G, H, I. Now the first year, the initial year is fixed at 100 for all of them. the initial years is fixed at 100 for all of them, and B divided by A, E divided by D, and H divided by G. The same logic here, C divided by A, F divided by D, and I divided by G. This is a horizontal common size. So it is more like a trend. Initially, in the first year, when all these numbers were 100, I'm looking at now to what extent they have grown compared to the base year, by how much they have increased year over year until date. Probably it might so happen that the sales have gone up by 20%, but the gross profit has gone up by 50%, or any such kind of things could be there. So this is a horizontal common size, but the most common size analysis that is typically done is vertical. Each year's financial statement, each year's every category is divided by the sales or revenue of that particular category, which means the size effect is eliminated. Even if it is even if the sales are very high, I'm looking at the cost of goods sold in terms of percentage. I'm looking at the gross profit in terms of percentage. Otherwise, if I'm talking of a small company versus a larger company, obviously the sales of this will be much higher. The cost of goods sold also will be much higher compared to this. And it might very much be possible that net income in the dollar terms will be much higher for this compared to this. But if I start converting it into percentages, the size does not matter, because the revenues for this is also 100, the revenues for this is also 100. That gives us a scope to compare different companies which differ in size or even across time. The historical performance can quite comfortably be considered. So it becomes much easier to do a time series analysis, which is the comparison across time, and also a cross sectional analysis, which is more of a comparison across different companies as well. So that's the reason any income statement that is looked at, initially we perform a vertical common sizing analysis on that. And it can help me to understand the overall strategy of the firm. Where is it spending more? Is it spending more and more on cost of goods sold? Is it spending more and more on selling and marketing expenses? Or is it spending more and more on is the cost more and more on depreciation, which means did it spend more and more on fixed assets in the past? The whole strategy of the firm is going to come up, especially if I'm comparing two firms. The what are the key differences in terms of the operating expenses of both these firms can quite comfortably be understood by getting into this kind of common sizing analysis, right? And it can help us in doing a better prediction of the numbers or forecasting the financial statements quite comfortably for the future as well. So that's one of the prime reasons a vertical common size analysis becomes more and more helpful for us. And it even makes a lot of sense exhibiting or establishing every item of the income statement as a proportion of the revenue, except for tax. And generally for tax we don't establish it as a percentage of the revenue, but generally tax we try to establish it as a percentage of the profit before tax, and we try to call this number typically as the effective tax rate. That particular tax as a proportion of the pre-tax income. So that's one kind of an analysis that is performed on the income statement. Then the ratios, okay, some of these ratios are named purely based on the two different values of the income statement. And pure income statement ratios, majority of them deal with the margins. The margin based ratios more and more factor of the profitability, determinants of the profitability of the firm. So the two major ratios, the gross profit margin, I look at it as gross profit divided by revenue or the sales. Then I have the net profit margin, which is again the net income divided by the revenue or the sales. Now, in isolation, this ratio may not have major significance, but if I compare it over time, how this gross profit of this firm has been changing year over year, or if I compare it with the industry standard or if the competitors, I could see how this company is performing compared to the competition or where is it placed with respect to the industry. So if the gross profit margin has gone up, I could very clearly assess whether it is because of the revenue going up or it is because of the expenses going down. Such kind of clear-cut understanding and evaluation can be done by computing the ratios on a broader scale. So I could clearly see the once I look at the ratios and do the comparisons, I could very well assess the strengths of the company from the performances, and I could also assess the areas of improvement on the same. And probably a few more ratios on the same lines. I could talk about operating income divided by the revenues, giving me the operating profit margin, or I could talk about the profit before tax divided by the revenue, giving me pre-tax kind of a margin. All these kinds of different margin based ratios can very well be obtained from the income statement. They could quite comfortably be used for comparing the historical performances or the performances with respect to the competitors. So every income statement we can do such kind of analysis and try to derive some strengths and weaknesses of the company which we are analyzing. All right.